right, CTM. We get to do it again. Listen, someone said that they have to leave mid-session. Awesome. Awesome. But make sure you come back and watch the second half. Absolutely explosive. It's a long one. It's going to be a long session, but I had the best time yesterday with Ian and Ted sitting down and working this out. Absolutely beautiful. You're going to love it, and you're going to get to know them and their work a lot better. Let's go ahead. Let's join over. Let's get going. And let me just go ahead and begin.
So to get started.
Yeah, but let me just open up by saying that first, Jordan, you've been a rock for me during this entire time. So thank you for continuing to have the calm head, and Ian, you too. As you both know, I'm a position guy, right? And I do trading on the side. I built up a pretty good portfolio over my years. So I'm kind of like you, Jordan. I'm 30% in. So, and this was before I met you online.
Really quick, we don't have an echo now, right? Because there's only one instance playing. We shouldn't have an echo. Dan, confirm that with me or everyone else. Listen, if you could go ahead and you could, in the bottom right, you could change the quality of this to as high as quality as possible, okay? I recommend doing that as we get started over here. This is actually going to be absolutely amazing. You guys are going to love it. I know I did.
And, so I was glad to hear that you were doing something similar, as well as Raul out there doing something similar, because I really do believe Bitcoin as a long-term asset is a good play. That said, I will say that this little drawdown, it took me by surprise. And the chart that you had up today, I think I went through the tail end of all those things this weekend, all the feelings, right?
Yeah.
So, it did shake me in terms of like wondering, are we still in the 4-year cycle? I do agree with you, Jordan, that I believe that I think the thing we all missed was what you mentioned on today's video, which was the peak to drawdown between the two cycles. If you average them, it happens to be just near, where we're at today in terms of drawdown. So I think that gives me some solace. The model, gave me some solace also, because, back on I think it was on the 14th when I was showing you, I was seeing that 33 number and I'm like, there's no way that's going to happen. And then it happened. So I think for right now, what I'm trying to figure out is moving. I think in my head, I've wrapped around, I've concluded that, well, this looks like the pullback. I think that it is. I think it's a little bit anomalous from the sense of, yeah, it's deeper than normal. A lot of people talk about these moving averages. We are below a bunch of moving averages, which I think we were actually in 2013 also, right? So I think I'm trying now to kind of refocus and start to look forward and decide on the next two bumps, right? And the ones that Ian is focusing on specifically. And my counterpoint to this is that, in the back of my head, I have Cowen's other model, which is the model I started with back in December of 2020. And that's the model where I think if we get near that 100K-ish number, or 80 or 90 or 100, I think that first dip is around that point, or that the next first or second dip. And I think that's a point for me where I have to figure out, well, am I going to dilute, am I going to DCA out at least some of my profit? And I'll just tell you what's so funny about this, guys, is that I have an advisor through Merrill that just manages what I call my capital portfolios, my don't touch money, right? And I was telling her about this, and she was like, you should be taking like 30 or 40% just taking on. And I'm like, you don't know what you're talking about. And then a week later, all this giant drawdown happened, right? So so, I think conviction wise, I think I still have conviction. I don't, unless this line's going to go way outside the model, right? I don't think we're headed there. I think it's just normal. I see smoldering fires around me right now, and I'm just saying, stay calm. I think that's the right answer right now. So I think the focus now for me is, well, how do we handle the next two dips? How do we foresee them better? I know on my chart, Ian and I have been discussing specifically how do we name them? What's the nomenclature behind them, right? How do we characterize them? And make sure that the community understands if there's something larger than what we're it's very easy on these charts just to go, oh, it's just, it's an average. It's only going to be, is the next one going to be like a little bit larger? Is it going to be like a 36 or 38 or 40 or 42 instead of like the normal 20 to 27?
Right.
I think that really shocked everybody. I know it shocked me, right? And I was on Discord like the whole weekend, and I had to turn it off. I mean, honestly, there were so many upset people out there. And it just told me that a lot of people were not prepared for, they didn't take your advice. I think that's the first thing they didn't do. And I'll be honest with you, Jordan, I didn't take your advice. I actually had a small cost of, I think, I don't know if you saw it on Discord, but I had a small loan that I had taken out, not for leverage, just for living expenses. And the liquidation level was way down at like 18,950. This dip here scared me enough to pay that back. Wow. And I didn't lose any money on it. I paid it back with coins that I had made 3x on. So it's a win, but it was enough. The word shakeout, boy, is that appropriate for this. And when you say few are chosen, many are called, I'm like, this was a learning experience for me. So like, I think that I'm trying to put that all behind me this morning. And in fact, it was funny when you were showing the chart and you had like disbelief, anger. I went through anger over the weekend. And this morning I had to go to the grocery store shopping for my wife. We got actually the first time we go to see families tomorrow. They're coming in. And so I was at the store and I was like, man, I just feel really down today. And I'm like, came home, watched your video, and I'm like, oh, that's the depression phase. So I think it's playing out in my head the right way. Now it's just like, okay, get your focus back on the game, right? And try to figure out how to handle these next two dips. I think that's where I'm trying to head. And my only, like I said, counterpoint is, are we too stuck on the averaging model? And if so, like, what are the constraints that we would use to say, hey, we should probably abandon that model or look at a different model? Like, I was really happy over the weekend to see Plan B, for example, say, here's stock to flow, 2 standard deviations out, the low is 30. You should, and we can be here at 30 for the next couple of weeks, that's okay, but going on a month, that might be a problem, right? So I think that's kind of my boundaries is next 2 bumps, and when do we make a call that says, this is not the model? I think you're kind of like saying it today, right? We just don't know, we don't have clarity. We have to let things play out. And I guess that's my real, from a direction standpoint, how long do we wait? Does the model have to go all the way out a deviation or 2 or 3 before we decide to give it out? Wow. So that's kind of where I'm at.
That's great. I mean, they're beautiful. There's so much to compliment there. But quick question before I even do, we have stock to flow and then stock to flow 2x.
Yeah.
Why are there 2 models? And, you almost can't get it wrong, right? If Bitcoin trades, 150,000, look, I was right, stock to flow. If Bitcoin trades, 250, 300,000, look, I was right, stock to flow.
Yeah.
What's the difference between the 2 models? Do you know?
So from my analysis, there was actually 3 iterations. There's 2 time series models. There's stock to flow version 1, which was 50,000, like 55. That was his first model. He said, oh, that's a mistake. You retracted that. Good. Then he came with stock to flow version 2, which I think has the 100K target.
Right.
And stock to flow FX, technically, if you go do all the reading on it, it's not a time series model. It's really a market cap versus the amount of flow coming into the market. And if you go look at it, what you'll see is like he has clusters, right? So he'll have silver, gold, real estate, like all diamonds, for example. And you can watch Bitcoin kind of invading each cluster. And he says, we're on our way to gold right now. And what he has said about FX is effectively, he says, well, anywhere between 2022 or 2020 and 2024, we could hit that number based on the trajectory of what's happened. So when he talks about that stock to flow FX model, a lot of times he'll talk out of both sides of his face. He goes, well, we're on track, but at the same point in time, I'll see him say other things where he goes, well, really, no, you got to remember, it's a clustering model. We could take a zigzag way over here, just as long as it gets all the way to, in 2024, if it's the gold number, then my model's right. So I think you're right in your assessment that can he be wrong? Well, the only way he's going to be wrong if Bitcoin drops down to 0, right? So my kind of take is right now, is that stock to flow is kind of the minimum number. I think that's the 100K number. But I think his conviction is that he's seeing the 288 number on the horizon based on our trajectory and based on prior history of what it was doing with the clustering model.
Yeah.
So
important for those that are just, following us now, maybe even a little bit newer to the space. If you are following any of Plan B's work and the stock to flow model, those models are expected to overshoot. If he says 100,000 for stock to flow, it's expected to overshoot that. Even the 288,000 stock to flow X, that's expected to overshoot 288,000.
Yeah, he says 2 to 3x. That's usually his numbers he throws out. So I mean, even if you hit stock to flow version 1, 200,000's on the table, 300 your outlier, I think. Stock to flow FX, I mean, that's 500 to 700,000, I think.
Yeah.
So anyway, I'll stop talking. Ian, I'm sure you've done some research. What's your color on all this?
I mean, I wrote some notes down earlier. I mean, for me, it was the way that we entered the dip that I felt very uncomfortable about, because effectively the trajectory for the previous 2 cycles, certainly in the last 35 days before the actual real shakeout happens, is that we're coming down and then down, whereas effectively the trajectory that we had coming in is we had a long consolidation, and then effectively we had the initial dip. And because we had that long consolidation, in my mind, I was thinking, right, this is the dip. It's right on cue. It ties up with the golden ratio, the 51-49 ratio on the timing. It's right on time. There's the dip. We come back out. Everything's working. Yeah. As far as the overall model and looking at the whole sort of bull run cycle. And it was when it effectively then rolled and turned sharply. Then the alarm bells really went off in my head. Yeah. And as it's played out now, if you realign the dips, you actually see that 35-day entry into the shakeout symmetrical on all 3. Yeah.
Yeah, it's really amazing. Did you, on the 2013 one, it's really crazy. You can see, like,
before we continue, hold your thought. I just want someone to pull up a chart of what we're talking about.
Yeah, so if you was to go back about 35 days from effectively the bottom of the shakeout, yeah, you can see that all the shakeouts start.
Yeah.
No, you're too far back.
Right, for the 14th of April.
Yeah, about there. Yeah, you can see that all the shakeouts line up. Yeah, going into the dip. Yeah. And then the only difference is that so that's that phase, and the phases. So what you see with our particular cycle is that, and this is the thing I didn't it's still an open question for me, is that you can see that for the 2012 cycle, you've got a lot of volatility to the upside, and it settles out, and then effectively it gets into this 35-day drop. Yeah. Mm-hmm. And then on the 2016 cycle, you slowly, steadily progress in price. And then the 35-day dip starts, and it plays out the same, but the dip isn't as big. Yeah.
Mm-hmm. Yeah, from here to here.
Yeah.
What's interesting is people keep saying that that this current cycle is now resembling more the 2012 cycle. If I look at this current cycle, it's almost a smoother medium of the 2012 cycle.
Yeah. So if we look back from the 35 days into more the past, yeah, you can see that we're elevated above the 2016 cycle in price.
Oh, way back here. Yeah.
Yeah.
Yeah. In fact, if you drop back, we're outperforming both. Yeah. Coming in.
Yeah. So we're outperforming, at one point we're outperforming both cycles. Yeah. Then effectively the 2012 cycle outperforms us. I mean, we're only outperforming the 2016 cycle. Yeah. Yeah. And then eventually the dip occurs. So, and this ties back to I think, so at first I thought, this is all down to QE. Yeah. That's why we're above the 2016 cycle. It's all completely down to QE, and that's the reason. But when I think it was George sent me a chart that I could scale against Q2.
M2.
Yeah. It effectively brings that level down that we're going through at the moment, but it doesn't bring it down enough. We're still elevated in this cycle compared to 2016. Yeah.
Is that the one that you posted on the Discord?
Yeah. So
Let's see if I can pull that up.
so
Was that M2 or was that QE? It was M2.
sorry, M2. Sorry, I shouldn't mix the terms too much. But it was just to get a feel for if effectively all this printing and all this had affected what, I'm trying to find out why we're elevated in this cycle.
That's also been my premise, also because of the expansion of the monetary supply, because of the QE right now, we're outperforming last cycle. When I see this chart right now and talking with both of you, it brings a new perspective for me, though. I really see, when you start in mid-February, when you see the 2012 really spike above, when it has that blow off top, that's really the only time it greatly disconnects from this current cycle. But then in the time afterwards, you see the big drawdown, and then it's just basically averaging out this current cycle.
Yeah, I mean, you can even see the dips in the 2012, the peaks in the 2012, the cycles happening on a smaller scale on the 2020s.
Even that, wow. Yeah.
It's crazy. It's almost like they took 2013 and it's being muted by 2016, or 2012 and muted by 2016.
And what's interesting going forward from here, if this continues to hold, is that 2012 actually came out slower than 2016. From the dip, 2016 sees about 140% increase in about 30, 40 days. But 2012 comes out much slower.
Yeah. And I think that's to my mindset, the reason that 2000. So this is one reason why I was a little concerned to use the scaling from the dip coming out,
right?
Because effectively I was worried that the ultimate price that we get at the end, we might be miscalculating because we're not going from the halving.
Okay.
Yeah.
Yeah.
But what it does do is it does show that as we come out, if the 2012 cycle comes out slower, as you say. Yeah. So it's almost as though from the bottom of the shakeout to effectively when they then cross over again later on around the 35-day point from the top. Yeah. That effectively the roles have been reversed. The 2016 cycle out of the shakeout is much more aggressive. Yeah. And then it seems to slow down, whereas the 2016 comes out more aggressive, yeah, and then it slows down, whereas the 2012 cycle comes out slower and then blows off right at the end in that 35-day period towards the end. And I can only think that that's because it has pre-shakeout more volatility to the upside. So effectively the volatility coming out of the shakeout is reduced, yeah, before it then gets up ahead of steam to effectively, I mean, that's what I'm from just sort of looking at the flow of the model. Yeah. Does that make sense? Am I making sense?
I think you're making sense. I kind of, what this dip kind of taught me is that I don't know enough about the on-chain data to say whether or not the behavior that we're seeing now is congruent, with its returns. Every time I go look at it, I walk away convincing myself that we're still in the middle of a bull market. The metrics are nowhere near their peak. The only one that kind of, it's not even Pi cycle is the only thing that actually there were two. There was a Pi cycle. I think there was a MACD indicator that kind of clipped. But all the other indicators on looking to Bitcoin were all fine. And, you know, it says we're in wave one of the 3 waves, right, of Bitcoin's appreciation. Every time I look at it, I'm like, we're fine. I think the problem is just the scale of this dip. And I think, Jordan, you asked a very interesting question while coming into this was this dip the dip, or was this dip an anomaly? And I don't know. It's really hard to say. I mean, you know, I did see that recently that Goldman Sachs jumped back into the market, and they happened to jump in right about here. Right. And I've read that they have positioned near 30, right? So it wouldn't shock me at all if, you know, if they somehow use their dollars to short and force it down and use the additional FUD that was out there to kind of take advantage of the situation. And maybe this was our dip. It's hard to say. It's just like I said, the scale and the violence of it is just really shocking to me. I think that's my kind of going into it. And then I'm just wondering, I mean, are we gonna, if it is this scale, at this scale, and it's fine, then I'm tending to think we're going to be more following like this on the bottom, following kind of tracing 2013. And then, like we just said, when you cross over, it's going to do this. It's going to be, again, following 2013. We're going to be more near the high.
100%. That's exactly what I see happening from here. Now, prior to this conversation, one of the questions that I really wanted to discuss and answer with you all was whether or not what I thought originally was the mid-cycle shakeout. You know, when we had that 30% drawdown, and then all of a sudden, was this an anomaly that occurred, this big shakeout because of triggered by Elon, and then you had that what was it, a coordinated attack, you know? But when you line up the charts like this, and I'm looking at, as we just looked at together, the peaks that we saw back in February between this cycle and the 2012 cycle, and then right after that, again in early March, the peaks again, and how the symmetry between both cycles is so clear and so apparent, even coming in to that, basically that 35-day drawdown into it continues throughout. Then I have to say, well, after this was presented by both of you today and Ian walking us through it, it seems very clear to me. And this, because I'm not sure. Well, listen, are we looking at approximately, 150 days into the middle to late October for the peak, or is it still going to be, into September? I have to lean at this moment towards this, and I do believe, as Ted walked us through what he foresees, that we're going to be hugging closer to the 2012 trajectory up until we get to that final liftoff point. That's where I'm seeing now. I feel like this current event, though, which caught myself and everyone off guard. In hindsight, it's a little bit easier to say, oh yeah, well, okay. But in the moment it was occurring, getting neutral from the uncertainty or whatever, it caught me off guard. And I didn't expect a 53% drawdown or anything close to that. As I'm watching that unfold, it says to me now, going forward, do we need to be so precise on wave one and wave two and trying to tame them? Or right now, is it smarter to actually lower my time preference and be looking from the bottom of the dip here and then trying to time up what we perceive to be somewhere around mid-September, right before that last dip, before we hit into the blow off top? What does it make sense to really trying to be timing this thing like to the degree that we were trying to do it, or right now, because of the uncertainty, just make sure that we continue to have these markers, continue to check that we're within range, but definitely take the vantage point of a little bit of a lower perspective, a lower time preference. Now, I have to also tell you, as we were going through this drawdown, I wasn't in the least bit shook. I was not even, my fear gauge was not even, I've been through this before, and the reason I say that is because while you're going through all these emotions, and it's something that, that I've been going through since 2016, I feel like you're catching up in like so much quicker, and you don't have to go through the years that I went through or anything like that.
Yeah.
You know, the next
It's
time
much easier to be the holder, right? I mean, that's the good thing for me. I'm majority. It's in there. It's in the bank. I don't need the money, right? So it's an investment. That's the way I look at it, right? It's just normally my investment style is I'm working, and this is now I'm doing this full time, right? Normally, if it's kind of like when the S&P crashes, right? I'm like, when I had it all in my 401k, right? Up, down. You know, you're just not paying attention to it. Now, like I'm on it all day. It's just something that it's in front of your face. So
I mean, anyone that's invested in Bitcoin, I believe they should have right. I think we all have the same goal in mind. We understand that Bitcoin is looking at taking a larger share of M1, right? It's fighting for a piece of that $100 trillion market cap. And it's so tiny right now. It's below 1 trillion, right? Next milestone is overtaking gold's market cap. Yeah. And then, so our time horizon, I think anyone that's investing in Bitcoin and is a holder has that type of perspective. So if we do enter at any time what is clearly a lengthening cycle, okay, then that great. You know, we're all going to get there. Now, my whole let's say objective is to accumulate as much Bitcoin as possible, which is why I'm tracking the 4-year cycle. And if this continues to play out, I'm not just going to hold through what I know is going to be, you know, an 80-85% drawdown incoming. I'm going to use that as an opportunity to gain more Bitcoin. Now, it's quite possible come this October, November, we realize the 4-year cycle broke. And at that point, it then becomes, okay, well, that I just don't have the opportunity to accumulate more Bitcoin in this fashion, but I still have my position. I know where we're headed from here.
Yeah. So one quick question about the chart. Oh, go ahead, Ian.
I was just going to say, I didn't feel like I was stressed at all. I was too busy trying to work out what was going on. So. Yeah, so I guess for me is trying to learn the lessons from the trajectory of the cycle as we came in. You know, why we were elevated, why we had the price action for 2 or 3 months going sideways. All the indications at that stage was that was healthy consolidation. It turned into effectively a very volatile shakeout.
Yeah. Were we elevated from the all-time high break also? Let me take a look. So that's interesting. So from all-time high break, we were, except for this little shenanigans right there, you know, we were in between. So I guess it just depends on how you're scaling.
I mean, listen, going into the event and prior to the event, you have to be tracking it from the all-time high.
Yeah.
You can't do the scaled shakeout mid-cycle until it's occurred. So how did you know?
What I meant was is effectively back in December, yeah, we're effectively at the same price,
right?
Yeah, you know, as the 2016 cycle, yeah, and then effectively we average as we come through the rest of this year, yeah. So my point is that as the dip plays out, we come back to almost the same level as the 2016 dip. So from effectively...
right here, that's what you're saying, right?
We're elevated from the 2016 cycle. Now, if we didn't dip as hard, my point would be, oh, that's all healthy consolidation because effectively the price is what the price should be. But because we've dipped so hard, the narrative then of you know, if we remove the M2 scaling out of this, you still effectively get this elevated 6 months. That I was then effectively, when you saw that we were at all-time highs for leverage, that makes sense to me. That effectively this higher level has been created by everyone at home, kind of with COVID. Effectively, you know, you know, I wouldn't say young people, but people effectively betting on leverage, creating this kind of almost like a little bubble, and that bubble was unraveled. Yeah. So Elon's tweet is, so this get back to the question, you know, was this the shakeout or not? And to my mind, Elon's tweet was the catalyst. It effectively just, it was there and it was ready to happen, and it just needed someone to start it. Now, if other players saw that opportunity and effectively drove it down even harder, then, you know, this is the result. But you've got to have the leverage in place to start the cascade, haven't you? Yeah. So it's really just trying to learn from that, and then seeing how what we check as far as metrics as we come to the next dip that is going to happen. There will be, to my mind, at least, I would say 2 dips before we effectively get to our 35-day blow off top.
100%.
Yeah.
Listen, it wasn't easy.
It's trying to get ahead of that and be looking, almost have like a dashboard of metrics that we are looking for that are showing. Because if we get back into it, if effectively we get back into a bubble state, as it were, yeah, it's not a healthy correction, and we get too overextended again, yeah, that could be a signal. And I'm trying to get in front of that signal. I agree with you, Jordan, that trying to match the cycle perfectly on a day-to-day basis is going to be, you know, that's a fool's errand a little bit. I think that would be dangerous.
At the same time, you can't discount the symmetry taking place. And we are looking for the 2 more dips up until that 35-day blow off zone.
But it's just getting ahead of the fact that, oh, we can see things that we've seen in the past. We're in the right territory for a dip, as it were. Does that make sense?
Absolutely. Ted, if you could recenter that chart a little bit, going back towards, yeah, like that. Look, it was tricky. If you put it on the middle of April, Ted, if you could just write yeah, and you go to a little bit further to the right and then up towards the top of the yellow line. No, just your cursor, your mouse, and then to the right a little bit and up a little bit and then up right there. That part right there was super tricky. If you go back and as lining this up from the dip, you know, we're not lined up from the dip right now. We'll leave it as it is right now, right? If you go, let me actually take control.
You know, while you're doing that, let me just mention something that I've been hearing from, I mean, because I'm in Florida, so I don't know if you follow any of the Florida news, but there's this big malarkey about, you know, people are being paid to stay home and all this other craziness. And I know we know a lot of people who work in service and, you know, work like lawns and things of that nature. All those people, they're all invested in some form of crypto. I get in a conversation with them, right? And literally, I was just out yesterday at a restaurant, and what I heard there was, I mean, for everybody, it was like that was the talk behind the bar between all the folks. They were all freaking out about whatever, you name it. It wasn't necessarily just Bitcoin. It might have been Doge or, you know, Ethereum or whatever. My lawn sprinkler guy, he actually texted me over the weekend, right, with this stuff. So Ian, you might be onto something with that. There might have been a lot of just extra floating money sitting around. And even if it wasn't leveraged, I mean, people saw this dip, right? And especially when somebody like Elon tweets it, that holds a lot of weight for people. And they might have just started pulling their cash, and it just created a sort of cascade effect.
Yeah, I mean, I think it's William Clementine.
Yeah, William Clementine the third, that guy.
Yeah. So he put out a chart after showing that the amount of leverage had greatly reduced.
Yeah.
And I just thought, you know, I'm trying to sort of find the narrative that supports effectively the price action, and that's the one that I can't. You know, I thought before the dip that the lack of volatility, you know, in the dips was down to QE, and now I'm thinking more that it was down to effectively more leverage in the system than was healthy. And then effectively the opportunity was presented to people, yeah, with someone like Elon's tweet. And, you know, and they took full advantage of it. Yeah.
They're all
And
connected.
everyone
The
just
reason why
cascaded
there was
out.
able to be so much more leverage in the system was a result also of QE. In the 2016 cycle, we didn't have people leveraging into Bitcoin and alts the way they did, but it was a different type of leverage. It was done through people speculating on different altcoins and the ICOs that were taking place. And that then gave people more money to put into Bitcoin. So that's why we saw the different type of alt cycles that we see compared to right now. So it was also present in the system, just in a different way. When we line up this up from the scale, it's very easy for me to see how this is mirroring, right? The 2012 cycle over here. I mean, almost perfectly. And when you brought that up in today's session, it's just like, it's abundantly clear for me and for everyone. What is not clear and what is difficult, right? What I want to get your opinions on and look at, if we're looking at this in real time as we were, and not lining this up from the scale dip anymore, but you know, prior to that point, using the prior all-time high, which in my opinion, using the halving, lining everything up from the halving up until price in the cycle makes a new all-time high, is the best way forward, right? And then until you have the mid-cycle dip and then lining them up, as you could see when we just lined them up, how clear it is, right? It's like, as you reach this milestone, then going forward, you could square up your situational awareness and get it much tighter. Now,
if you look at the where the dip starts,
this is where the dip started.
Yeah. So just on the right of, just as the dip starts, yeah. Now, if you look down onto the 2016 cycle, yeah, it goes sideways as it comes out of the dip. Sorry, on the right hand side, it goes sideways, yeah, and then it goes up, and then it moves up.
Sure.
Yeah, and that's
sure.
Yeah.
Sure.
And it is at that point, and it was literally when it went down, that down bar there that you're looking at,
right?
That was signal. I think that was the day we had our Zoom call.
Well. I mean, this is me thinking that all three are pretty lined up.
Yeah,
exactly. And then I thought we're coming out, and then when this happened, that's Friday the 14th, right?
Yeah, exactly. Yeah,
that's the day. Like, wait, something's wrong. I don't know what's going on, right? I mean, but no, now having that clarity that you brought up when we rescale this from the dip, right? I'm able to say, oh, look at this, and then the drawdown here, and then the scale up, and then, oh, this is actually happening almost exactly. It's just more of a smoother average of the two, but it's very clear. Well, I could see that now that the dip has happened, but in real time, when I'm looking at things, when I'm looking at when I'm watching this in real time, I can't see that, right?
No, because until you
right
see,
here, this event right
on
here,
Friday, there's no way that you can effectively know which way that's going to go. Yeah, it's only, like you say, on that Friday, you see the drop, it's wrong. Yeah, up until that Friday,
a lot of people didn't pick up on that. I mean, it's signal when I'm like, I don't know what's going on, something's not right. A lot of people do not pick up on that. Here's what I'm trying to get at. In the 2012 cycle over here, you could see these lower highs being made all the way into the dip. That also occurred in 2016 cycle. It's the lower highs going into the dip. That changed right here. This one was different. That's why, we're trying to get that precision down through all the cycles. But this was different, right? And that just made this all much more difficult. There's no answer through it, but it's definitely pointing out the one major difference. In the 2016 cycle, you had the lower highs going into the dip. Yeah. People are calling this a Y-cliff distribution event. I mean, I personally don't think so. We'll see by the recovery, right? Whether or not we get back on track or not. But what happened there, I think all it is that reminder not to ever get comfortable, right? Not to get comfortable, but always be coming from a place of humility and having that awareness that you don't know what's going to happen next. You want to have your confidence, and you want to have those awareness points, like we are looking going forward. Let me line it up really quick just to where we are today. Going forward, yes, we are looking, at wave 1, wave 2. We want to see that occur, but understanding that within this area, why Ted pointed out, yeah, we expect this to be hugging more towards 2012, an average of the both.
Actually, what might happen as a result of this is that if we take the thesis that this is sort of a muted 2013, we might ride under 2013 going to the top. In other words, we may be outside of that boundary on the centered model. Because I mean, if you would just draw the line, you see how like on the bumps coming in, right? We're underperforming 2013. Well, there's nothing to say that underperforming 2013, as long as we're hugging it going up, as long as we're making higher lows, higher highs along the way, I think it's just model guidance, right? Now, like everybody else has said, Jordan, like, well, if it just goes to the right flat or does Wyckoff, well, we'll know. But I don't think there's anything wrong with being outside of these two lines, because if we're above 2013, that means we're outperforming 2013. And maybe that would be the case. I mean, historically, I guess that coming into this scale model it was, but if you flip back to the normal all-time high, I think we're underperforming 2013.
Well, before I do that, that's fantastic insight. I'm glad you shared that when you did. That's really important. And just why we're here again, after the expected peak of this is the dip over here. After the expected peak, somewhere to mid to late October, if we're going sideways over here, that's when I would say, well, the 4-year cycle is broken, right? Okay. Yeah, that's when I'll say it's broken, right? Now, that doesn't mean that we can't have diminishing returns in the fact that we underperform even 2016, but that would still be, okay, we're still expecting that 80-85% drawdown from there. That's a blow off top and we know, but if we're going sideways and we continue to go sideways past there, then we know that, okay, the 4-year cycle is broken. Let me go back where you said the all-time high. That's your last thought.
Underperforming.
You said we were outperforming 2013.
Or no, we were underperforming 2013. Yeah. So in this chart, we should technically be below. This chart to me makes more sense. There's an anomalous thing that's going on right here with our drop, but just as long as we're recovering from it, we get, like you were saying, I think we need a month or two to figure out what's going to happen. I don't have a better answer for that. Other than to wait. I think we're gonna have to wait.
In that. Do you agree with that, Ian?
Yeah, I think coming out of the dip, what really isn't helpful is that they effectively cross. So you end up effectively, there's not a lot of wiggle room in the price projection.
Yeah.
When you've got the chart lined up either way. Yeah. And I think that, from that makes it then, if you're then using that as a guide for tracking, it may, I think you could see how people effectively are discounting the model already. Yeah.
I can't. That's difficult for me to understand.
Yeah. Within a day, one of the dips occurs, or within a handful of days, after 350 days, or or what is it from the halving? I mean, yeah, it's massive. But I think people, I think Ted mentioned it as well. I think there's been a lot of reliance on the model.
One of the problems with this model is that it's really not a model, right? It's we're looking at past performance. It is a model, but it's not in the sense of traditional statistical models. The better model is actually Plan B's stock to flow with the bands, because that basically says, hey, even though we had this existential shock to the system, right? His model says the low band was 30K. So I'm like, I saw that over the weekend and I was like, oh, okay. So we're still in the performance band. We're still in the performance envelope. And so his tweet was, if we can stay here for a couple of weeks, but if we go on for a few months, then this model is broken. This is the core model. And I think this model really tells you a story. It says, hey, we're still in the blue band. It's fine. Our model has a lot more precision into it. Yes. And I think it can be misleading. You can look at it and go, well, that's a bunch of, in fact, I think I saw Monty on their thing. He said it was a bunch of quote unquote codwallop. so, I mean, and I can see that. I mean, I tried to fix that. I mean, in this by Jordan, if you go under settings for this and you flip on this adjust button, what that does is like, it tries to add some of the current volatility into there. And this basically puts some standard deviation, kind of like what, is going on here. But because when you come out of the dip, the performances flip, right? Now we get this giant squished envelope. Now this might end up being true. I don't know, but, I was just trying to figure out a way to show that. And unfortunately, I don't have, you can't do all the things that Plan B is doing inside of this tool. So in many ways over the weekend, I just dropped back to Plan B's band model. And I said, we're in the band. So that's the only thing that counts right now. His model is the model that's driving all this. And we've dropped. And then I had to go back through here and look and see, well, has it ever on a bull market, hit the bottom before? And it has. I mean, going up in the 2016 model, it's
the same
on the bottom.
At the same exact time, the mid-cycle dip right here.
Yep. Now, what's interesting is Ian's point, which is look how we were outperforming on this model comparatively to 2016, right? And that's the part that I wonder, is that M1, is that the extra dollars that are floating around the system, the excess leverage, everybody betting? I don't know, but it's certainly something of interest. But either which way, it's still inside these bands.
Absolutely. That was also the point made on Monday during the live stream. Now, just as we're talking about the model could be proven wrong around this area over here, right? At the same time, people that are questioning or wondering whether this way of looking at the 4-year cycle is correct, once we get over here, if this plays out, how could they argue that it's not correct?
Oh,
at the same time, I could say, well, I know where I'm wrong. But at the same time, and I had this conversation with Ben, and Ben not only agreed with that, Ben said, listen, if this plays out over here, at that point, he's willing to say, well, clearly I see it happening. I'm already preparing my audience that it seems like it's happening. But, this is more of like, waiting to this point over here. Well, beyond this, if you're still not admitting it's correct, I can't see that as well,
What I've been seeing is where this dip right here is a critical juncture between all the models. It's going to break one of them or all of them, I think. And, because if you look at Ben's models, Ben's are a logarithmic curve. He has buy and sell zones. It's very easy to profit. He's fitted it on his last 2 points, whereas you have stock to flow, which doesn't use any of the charts, right? It uses generation of Bitcoins versus market cap. It's a completely different way of looking at it. So one of those two models is going to break here coming up soon. And like his argument to us is that we're using averages. My argument to him is he's drawn a logarithmic curve. We're all using price, right? Stock to flow has a price element to it, but it's based on market cap, on the total market cap growth, which is a price element. But I mean, it doesn't depend on where these things move, right? It's based on the generation of Bitcoins in the system, which is a very traditional analysis strategy for any commodity that is in the marketplace, because commodities don't generate cash flow. You have to use a stock to flow model for all types of commodities. So I'm leaning more to Plan B as the number one, which is basically this is a derivative of Plan B. So I'm aligned with that. I think we're all good. I think the message to the community is you got to take this as just a bunch of lines. Don't use the boundaries as like this green area. Maybe I should delete the green area to say like we're in the middle. It's really just directional, right? If we're going up and everything else is going up, we're well. and you need to validate it against stock to flow, because that's what this model is. This is stock to flow.
100% with precision. So I have a question though. Before, are we certain that what's occurring over here is the dip, and that's the scale dip? Is this a possibility? This is an anomaly, and the reason I ask that is only because for us knowing when the cycle peak is happening, whether or not it's going to be the middle to end of September or October. Now, do we have to wait some more time, like we were saying, maybe another 30, 60 days in order to be able to determine that? Or do we know for sure right here? Why I feel like this is, and especially when you line it up from the scale dip, and we could see how Ian was pointing out very clearly the symmetry between.
So also remember, though it breaks the golden ratio,
Yeah,
what this does do is it confirms that 150 days from the major shakeout event is the top on both cycles. So if you look at the length of both, if you look at the bull run of the previous two cycles, one is like 370 days and one is 525 days. So those cycle lengths are different. If you look at the length of the halving to halving, the actual 4-year cycle, they're different for those two. So I think I sent in the Discord chat, I showed the length of the halvings, of the 4-year cycles. The 2012 cycle is significantly shorter than the cycle before and the cycle after.
I mean, this is one thing that's important over here. The golden ratio is broken. The golden ratio is that from the bottom of the lowest point of the bear market, the capitulation up into the halving, that many days, less 2%, 51%, 49% has been the length of the bull market. If we're not peaking now towards the end of September, the golden ratio has broken, right? So if we're lining it up like this, and we're looking at approximately 150 days, the golden ratio has broken. Something is different this time. We knew going in that, listen, we're looking for it to rhyme. It's not going to be the exact same, but that's a pretty big deal, right? So
but my reason go on, sorry.
That's why I'm leaving open at this point the possibility that the peak is the window between, September 21st and October 31st. I don't know yet where that's going to be. I lean towards 150 days from this bottom over here, but
I think if you see the 35-day peak occur 30 days earlier and price action start to move up aggressively, then
we know.
Then that is for me more so than the peak that is likely to happen between those two, between the shakeout and the 35-day start. There will be another dip, high probability, likely to be maybe when it gets to the all-time high or there or thereabouts. That's when we have to start looking for it, I think. But if you get to August and you see a dip and price action comes back out and it goes aggressive, then I think the golden ratio is back on the table, and
that's good awareness. Yep,
that's how I see it. But at the moment, that's a 50% drawdown right in the middle. It lines up with 150 days. The price action before it is perfectly lined up with previous price action.
Very well said. Very well said. Perfect.
But can I just go back to the point about the length of the cycles? So I sent a little table, and I think it probably explains it in our chat.
Let me pull that up 1 second.
We just look at that. So effectively look at the duration of the cycles. The first one, 1,425 days. the next one, 1319, which is the one that the golden ratio shows as a smaller cycle, and why we can't ever line up the halving tracker very well.
Yes.
Yeah. Then effectively we look at our own cycles. Yeah. So then you've got the next one, which is
2006.
Is 1402. And then effectively using this halving clock, they're estimating the next halving to occur on the 17th of March, which is 1406 days. Yeah.
Yep.
And then if you use that and then you look at the way that our cycles played out, oh, it's the same time. Yeah. You're getting the same so now you've got, so that what I'm trying to do is explain why I believe that we've got this dip and it's happened right on time and it all lines up.
Is what you're saying from this dip projecting forward to the next halving? It's right on time, actually.
Well, what I'm saying is the reason that we could never line up the 2012 cycle, is that effectively is shorter. It's a shorter cycle in so many different ways.
Mm-hmm.
Yeah.
100 days shorter, right?
Yeah. So effectively, so if you was to, everything's a bit of a generalization, but that's why, that cycle length is shorter, but effectively, if you move it in line, so say I did 100 days onto this cycle, it all lines up perfectly. Why is that cycle shorter? I don't really know, but everything else lines up perfectly. So that's why I come back to the 150 days going back from the top, to look at it in a sort of a reverse way. If I line everything up from the top, it works.
Now, when you say line everything up from the top, do you mean from the expected date over here of the next halving on the 17th of March, 2024, and then work backwards to where we are? What do you mean from lining up from the top?
Oh, sorry, on the top of the bull run. So what I'm trying to say is, from a general standpoint, the 2012 cycle is significantly shorter than the other cycles. And we see that when we try to line up the cycles on the halving tracker, everything looks off, by 100 days or so, But when you actually look at the length of that cycle, it's 100 days shorter.
And I don't know why, personally.
Yeah. So, but if you effectively...
Is that the premise of lengthening cycles because of that? Is that one of the data points that least that's not important? Let's not even get into that. That's not, and we will if all of a sudden, again, by where I said this model's wrong and the 4-year cycle doesn't exist anymore, if we start looking at into November, we're still going sideways over here, right around $100,000, under 100. I'm going to say, okay, well, let's see what's going on over there. But
so where I'm coming from is that the golden ratio effectively, it explains why the golden ratio would be could be broken, because effectively the first cycle in 2012 is a different length.
But the golden ratio
worked last time. It doesn't necessarily work now because you've got a third cycle to compare against.
Even with the shorter cycle, though, the golden ratio held. It would be different this time if it didn't hold. It would just be comparing back previous cycles. We would have to say, well, there's a difference.
But this golden ratio, if you effectively measured this golden ratio in a different way, then effectively, so you just went, if you lined everything up from the top, it would line up.
It's the same way, right? The golden ratio is using this is So
So yeah, it's probably a little hard for me to explain, but
that's okay. I want to understand. I mean, that's why we're here, right? Ted, do you understand what the?
I think
is all the significant events that have occurred over the last 3 cycles, they all line up. Yeah, except for
how many days this cycle?
except for the halving event on the 2012.
Right.
Yeah, everything else lines up. Yeah.
Mhm.
You know when we looked at the halving, I circled all the different events.
Definitely.
They all line up perfectly, and it's just the starting point on the 2012 that looks wrong. And the only thing I can see that's different about that is that cycle's shorter. Once it starts that cycle, everything else lines up.
100%, which is also why I lean towards, lining up from the halving. Once the new all-time high is made, lining up from that. Once we understand where the mid-cycle was dip is, continuing to make sure as we get more data and move forward that we continue to tighten it up. Does anyone disagree with that?
no.
So I went off a little bit on there. Apologies.
I kind of feel like going forward, assuming that the rest of this 4-year cycle plays out, assuming we go through the bear market, it plays out as past bear markets have played out, and now going into the next halving, this plays out again. I think in the next cycle, the 2024 cycle, the best way to line things up, the past cycles, is going to be initially from the halving event until the new all-time high is made. And then we move over and we go, okay, then now we're going to move over to the new all-time high, and we'll line up from the break of the new all-time high until we get to that mid-cycle dip. And if it's a little bit different, if it's different by, 10, 20, 30 days, we want to go ahead and scale them from there at that point, right? To continue the rest of the duration. That's where I'm leaning. As
And I
being
think the only extra I'd add is that I would discount heavily that I would effectively, the 2012 cycle, I would line it up not from the halving. Yeah.
okay.
To bring it in line, which is what we're kind of doing as we're going through this cycle. Because I think what you're going to,
I get you. What you're saying is the reason they're so off is
the symmetry between 2016 and 2020 really play out very well.
Yeah.
And then the 2012 cycle, apart from effectively its entry into the bull market being off, everything else lines up. So you would effectively shift the 2012 accordingly, and that would be your change. Which is kind of what what we've started to do, because we're lining up the 2012, on the all-time high. We're lining it up now on the,
we're getting to the same place, just a little bit of a different way. I totally get you, understand what you're saying.
So I'm just going to present this as a quick topic. I was asked by one of the individuals in the Discord to try to look at measuring from the all-time or from the market low in the cycle to the high. And that basically, I think, is Ben's theory, right, of lengthening cycles. And you can kind of see it here on this chart. I think this is his story right here, saying, hey, as you see, as time goes by, right, it takes longer to get there, right? Except here's the interesting thing right now, and this is why my contention is, I think we're kind of at a make break of who's going to be right here. The purple line is riding right on cycle 3 from the all-time low. It doesn't look like the model, right? Any of his other, if I were doing this, I would expect it to kind of ride under that yellow bar. And I don't know if you can see my cursor, and I don't know if
absolutely.
So I would expect it to be way over here.
100%.
So I guess one warning that we could look at is if Cowan ends up being right, this could be a flat line all the way out to here. And
Which
that
is
would-
what I'm saying when we know the model's wrong, if that were to occur. I understand what you're saying, that the purple line, if we're seeing the lengthening cycles and diminishing returns, should be under the yellow line at this point, as in every previous cycle.
That's
But
right.
I think also everyone knows that we don't use the cycle one. We don't use that when we look at these things.
Yeah, second one's sort of an
Line things
anomaly.
up from the cycle top, the cycle bottom, the previous all-time high, the halving event. Lining them up from the cycle bottom is the only one that you could kind of like, push the case that we're seeing diminishing returns.
Yeah.
So I mean, look, I called him out. I didn't call him out on it. I mean, I was like, look, this is why you can't do that. And he's like, well, okay, but this is the only way it kind of, I don't think it's right. There's no way to it. And also, if we end at the cycle at the top of the yellow and just under it, right? Or like 10 days past it, could you really genuinely be like that was diminishing returns on a lengthening cycle?
Yeah.
On here, wow, it's
Well, I think it's interesting this cycle because we have I don't know if we have an anomaly with the low, but I mean you could probably call the March 2020 crash as sort of an anomalous event that I'm assuming he's using here, right, to kind of measure. And it makes me wonder, like, if that hadn't happened, where would this purpose line be? Would we actually be under the yellow line today? And
we're right about it.
Yeah. So I'm not sure. I mean, I think the price before you were showing it today, Jordan. I think what it bottomed out around 3K or something like that in March, and it was like 6 or 7 before coming in. So I don't know. It might put this purple line below it. It's hard to say. I just put this here for one reason, is that based on his own data, I look at this and I'm like, well, if your model is really holding true, then this purple line should be down here. And we should be going way out over here. And right now you're performing at cycle 3, that's 2016. So you're performing at 2016. And so that's my only thing right there. And I'll just say this, I've sort of made the decision myself, and you can tell me, Jordan, if I'm right or wrong about this, but I thought that adding this bottom indicator to our indicator that we're using just would confuse the message. If I put that in there, it's yet another model. People are not going to know which one to use. And I kind of felt like, well, if people want to sign up for that, they can go and research Ben's thesis, which he has a good thesis. I'm not going to knock him, but I'm not really following that right now. And I haven't done my research. And I didn't want to have to generate noise for you to go deal with, because I know that's what's going to happen. Somebody's going to flip that on. You're going to get 1,000 PMs. And I'm going to get 1,000 PMs, and Ian's going to get 1,000 PMs, right? And I just kind of thought when I saw this and I looked into it, I'm like, well, it just seems to me, it might be nice that these two are tracking, but our charts are showing they're tracking. So I'm kind of leaving it out, and I just want to make sure that's out in the air so that if you tell me to add it in, I will. But that's kind of where I think this is.
Ted, I think it's really important and constructive to follow and consider Ben's work so closely.
Yeah.
Because if any time in the future, call it end of October, November, that it's clear that it's correct.
Yeah.
Then you already want to know what's going on and follow it going forward.
Yeah.
Now, I personally attribute a very small chance of that happening. Personally,
Yeah.
Maybe I'm wrong. I don't know. If you look at the blue line and then you look at the orange line and the yellow line, and you're like lengthening cycles, diminishing returns, 100% I'm with you. But if that's the case, as you just pointed out, you're the first person I ever heard, then the purple line should be showing that same symmetry as the rest have been. Not kind of intersecting with the yellow line. By this point in the cycle, it should be well under. There should be space between the yellow line and the purple line. And then at that point, you'd be like, well, that's playing out. Right.
Yeah.
So, I mean, if that helps you at all, I mean, the way that you illustrated this here is very clear. The blue line kind of messes things up, I believe. Right. Well, I mean, everyone that I know, they removed that from the model. Right. That was the inception of Bitcoin. It was a little bit different. And they're focused on the previous two cycles, the 2012 and the 2016. Right.
Yeah.
If we end up slightly above or slightly below the yellow line a few days before or 30 days before, 30 days after, It's the same thing. You can't be like, oh, look, I was right. No, that's the 4-year cycle playing out without lengthening cycles or diminishing returns.
Yeah.
Right. So if that's helpful, I mean,
no, it's helpful. I just wanted to be open with everybody here that I had looked into it, and I don't feel comfortable adding it to that indicator. I mean, Ben's data and charts are really well done, and it's just another thing to confuse the message. I figure if people want to go look at his thesis, follow him. I mean, I follow him, I listen to him because it's just another perspective, right? So, and I figure this is what I'll reference people to if I get that question again.
how would he reconcile if you said to him, Ben, how come this purple line is not trading under the yellow line?
I don't know. That's a good question. I have no idea. I saw this chart. I mean, his argument on this tweet, I think, was how can you argue that we're not having lengthening cycles and diminishing returns? I'm like, yes, this definitely shows on these three that that's the case. But this purple line right now we're not diminishing returns yet. I mean, we'll see. Maybe he'll be right, but it's just the way it is. So I don't know what he would say, to be honest with you. I mean, it's really weird. I mean, if you look way back here, even, I mean, heck, this cycle was outperforming 2013.
That's right. And again, this is the only way you could line it up to even kind of make the case for it happening.
This may be, again, another argument for Ian's thesis of the monetary conditions are causing this. I mean, let's presume that Ben was right.
I think that was my thesis from the very beginning.
Oh, okay. So yeah, so if that's the case, then like maybe what's happening here is that let's say Ben's right. Okay, you're going to have this. Well, the monetary conditions have pushed this entire purple bar up. And we're going to follow this because of the monetary conditions this year, and it'll break his model in the end game, and we won't know until the next cycle if this really plays out or not. So, but I don't know. It's just an interesting chart to look at. I would like to show one more thing though. I don't know if you guys saw the thing I put in the Discord. So I posted this just as I'm always trying to question myself to break my own conviction. So this one I did here.
Yeah,
that's big enough, right? And this one was basically the gold market cap model that I kind of put together, where I just said, hey, let me take a look at the market cap, right? Because we're always hearing how Bitcoin's market cap is going to exceed gold. And
can you explain each axis to me so that.
Yep. So what we have here is on the left is Bitcoin price. That's the blue that you see going on Bitcoin, and the bars going down are a ratio of market cap. It's this gold times these numbers up here. That's basically the amount of gold in ounces and the number of Bitcoins. I didn't pick 18 million. I picked 15 million, presuming the lost coins that are out there. So that's, you could do it other ways. And you could also use the built-in trading view one if you wanted to. It just has different ratios, but the bars show up the same. But the interesting thing about this is that if you measure the market cap rise and falls, that's the blue lines, so up and down and up and down and up and down, and you put the halvings, it turns out that the down part where we're accelerating on Bitcoin happens to hit the middle almost every time. And if you project out your 2030, you get this 2013 number. Now, one of the things that's concerning about this is this blue, and I can't zoom this in right now, and I don't have a live chart of it, but there's this blue spike. That's the anomaly that we're seeing today. Right. And if I go back in time, there is a spike right here, right? But the one thing I am concerned about is it's far away from the top of the blue box, and this one's not. So I don't know if that's important or not. I mean, I like the fact that I'm arriving at 13 September along the same days. And in fact, if you calculate the price derived from this chart of, like, if you assume gold is 1850, you come out with a 450K sort of Bitcoin number. It's right in the middle. It's right along lines of Ian's number. I think his is 486 for the geometric mean. So,
keeps the golden ratio though.
Yeah. I don't know. Maybe these bars have to do with that same golden ratio, just in a different way. It could be.
Okay.
But what's interesting is even on the first cycle, you can see way back here. I mean, you're still following this red line business, on the halving. So it was just another data that I thought, well, hey, that speaks to something like this. But it also spoke of a warning saying, well, what happens if something happens and gold starts spiking? I mean, if Bitcoin isn't following along, it might break this model, right? So I don't know if it's important. I'm just always trying to find another way to kind of look at the problem and not, to break my own conviction. And I walked away thinking out of this, I'm like, oh, this looks good too. I think we're still doing the right thing. So I'm just presenting this here for completeness in case anybody wants to throw darts at it.
Ian, what's on your mind?
Well, I think that it feels like the golden ratio, the way that the chart is effectively showing the different ups and downs through the whole length of the cycle. So you come out with the 13th of September. So
we don't know. I mean, we don't know where
We just don't know.
And you said it the best. You said by the price action, as we get close to there, we're going to be able to get the best idea if we are peaking towards that middle of the end of September or into October.
Yeah, I mean, I think price says everything, really, doesn't it? And it's such a significant price move. It comes off of a dip and then it moves so fast. It's not going to be something that you're going to miss. Yeah.
No
And
way.
it's having it's really sort of seeing that as early as possible. Yeah. That's why I think that's probably the biggest event to happen. Yeah. That's
Absolutely.
the one that you're really looking for. And how you get there is really just trying to almost protect CTM between now and then.
Absolutely.
You've got a dip coming in between. It's going to be hard to find out because of effectively the way that it's not clear signal from the chart. We've seen a lot of manipulation. You've got a lot of leverage in the system. You need to, this is going to be the tricky part to effectively trade. Not for me, for me hodling, buying the dip, that's fine. But for people that are trading, they need to be aware of the, the difficulty through that phase. It's,
Yeah, no. There was one thing that I really wanted to go over with the two of you before we leave. Not that I'm trying to get out of here, but if there's anything else, could you please make me the host, Ted, really quick?
Yep, you're the host.
I'm the host. And let me go ahead and share the screen, bring this up for you. By the way, as we begin following price action, I saw it this morning on the live stream as I was looking at this. I don't know if either of you saw it, but I've spoke about the 4-step at the top that happened during both previous cycles. You could see it clearly here as well. That's also a sign, I believe, as we're in the blow off top, as we talked about, some people like to exit afterwards on the way down. This for me is the signal over here, the price action that if this is occurring again, there's no question after the 1, 2, 3, 4, on 4, I'm exiting, right? If we're seeing that unfold in real time, that's going to be a strong signal, right? 1, 2, 3, 4, 1, 2, 3, and on 4 is the exit for me. What I want to look at though is both previous cycles. Now, I don't know if I take the all-time high as we spiked up here in 2012, and then you fast forward, right? It's not until coming out of that last dip before the parabolic move that price makes a new all-time high again, right? I'm trying to see when we should be making a new all-time high this cycle, going off past cycles, or if you use this lower dip over here, right? And you could see again, it's right before it's before the crest of the second wave. It's still quite a ways in the distance that we would. Is it possible that we're not going to be making a new all-time high all the way until September, the early September, right? Preparing everyone mentally in case that was happening. Now in 2016, right, it didn't take us too long. The consolidation was not that far. It's actually on this current wave now, assuming this is the bottom. On wave 1, you make the new all-time high. So I think everyone needs to be mentally prepared. All-time high here, $64,000. Is it possible that's not made somewhere into the middle, the end, of August or the beginning of September. It's possible, right? And if that's happening, that does not mean the model's broken whatsoever, because you're just pointing out what happened in the past cycles and to see and preparing people for the possibility. When people talk about that, hey, maybe this was, I don't think that we go sideways making lower lows from here. I think that we're going to be in the process between where we are today and that possible, outlier, it occurring all the way the first week of September, right? I think within that period, we should not make a lower low than we have. And it should be, however it plays out, still wave 1 and 2. But, anyway, so I'm just throwing it out there as a possibility to prepare for. What do you think of that?
So what I was going to say is I would use the 35-day start of the dip, and then just factor in the way that price action comes into them both.
So I think you're trying to pull up Ted's chart over here.
Yeah. So effectively, yeah. So I would use the start of the dip,
which is right here where my mouse is.
Yeah. For each cycle, and how each cycle plays that dip out. So you can see that 2006, yeah. So 2012 takes that long.
Okay.
Yeah. 2016 is much shorter, but it comes in effectively not off of a high wave.
Oh,
yeah. So its price comes out more aggressive. Yeah.
Yeah.
And what we're seeing in 2020 is that we're seeing a hybrid, sort of like an average come in.
Right. Thank you. So I see where Ted has this marked already on July 19th. Yeah. That's actually where we currently should be making the new all-time high by, to know that we're on time.
Yeah, there or thereabouts. I think that's kind of. I don't personally think that we come out of this cycle as fast as we came out of 2016 because of the price action into it.
Right.
Yeah, which would be kind of like the 10th of June. Yeah. In blue. So to the left a bit more.
The 10th of June,
a bit more.
Here, right.
So I think you're coming out closer to effectively the 19th of July. Yeah, but yeah, say
pretty good marker.
Say 2/3 of the time between. What's it going to be? It's going to be something like the 11th of June to the 19th of July.
Okay.
As a horizontal date.
Excellent. Thank you.
That's my gut reaction when I look at how because of the way that we entered the cycle. Entered the start of the shakeout
from here to here.
Yeah. Because one effectively has.
And also, Ted's awareness point of over here is, again, also a very good one, right? And to be in that range somewhere around there, recovering 45,000 to that $52,000 range, that seems completely reasonable.
Yeah, I picked that date or that number there just because that seemed very similar to your Wyckoff, peaking up, and then potentially that might be a make break number if we're going to see it dart back down into that lower band that you were showing. The plan B, which is low probability, but I figured that number might be critical moving forward.
You guys have the best situational awareness points from where we are today. This is actually what we used to talk about today, and it is for sure it's the best.
Yeah, I mean, what I would say is not to freak out too much when we get to say 45. Yeah. Right. Because both cycles have shown that effectively there's a bit of sideways price action for a week or two before they then move up again.
Yes.
So if we come out of the dip, maybe we come out, that we get up to about 45, then we go sideways, and everyone's going to be like, "Oh, Wyckoff," and it's like, "Well, no, not yet." Yeah, we haven't. It's a bit, if we then do that sideways for a couple of weeks and we don't then see a progression out, that might be a signal. Yeah, when you then roll back over after a week or two, at 40, 45,
Yes.
that would be where I would get. The alarm bells would start to.
That option B is becoming, there's a high probability of becoming option A, would be confirmed if we took out the 30,000 loan.
Because however however it sort of goes out, it should go out, in that sort of way. Yeah. So if you start to see it and then it rolls over, then it's a Wyckoff, and we're all hodling for a little bit longer.
I love it.
Curious what everybody thinks. I mean, I kind of put Wyckoff like in the 3 to 5% range.
Right.
It just seems to me Plan B's model has been holding for so many years now to have some crazy, multi-month, strategic event. I mean, I know everybody says the institutions are here, but it just seems out of the ordinary to me that you'd almost break. I think you would break Plan B's model if we did a Wyckoff event in the middle of all this, for sure.
I mean, what I can't stress enough is that, okay, it looks like a Wyckoff, yeah, but but effectively 35 days before the shakeout occurred, for the last 3 cycles, they all did exactly the same thing.
Right.
Yeah.
Like, and that one is to the day. Now that's either someone's really planned that out well, yeah, and they've had it in a plan for the last 6 months, if not longer, to get it to hit that date, or it's just the way that, human psychology is, that there's always a mid-cycle dip, because of the psychology of people. And,
I see
the level
exactly the way that both you
play out again.
And when Ian says that around this point, come the middle of July, if actually we roll over, right? And that, that would be a little bit out of the norm. If we then take out the low, then listen, whether we expected it to happen or not, it's happening. Yeah. But Ted, that doesn't mean that Plan B's model is wrong if by that September, October we're out
right. Yes.
Highs again, and then
just as long as the event doesn't draw out to the point that it's outside the the bands, absolutely, and that could
it would be massively different. It would be massively different. At this point, we could not use this model for this type of precision. But if that occurred, we're aware of it, when it would happen, how it would look like, enough to make sure that we could lean into the model and know when to best accumulate out of it to be involved. If the institutions spent the time doing this, which I do not think they did, it resembles the pattern perfectly. I think it's coincidence. What Ian just said about, the similarity between past cycles down to, of course, that's what we're seeing. At least that's what the 3 of us are seeing. 3 to 5% chance. Okay. I can't put a number on it, but we'll know when it's happening. And if it's happening, we'll adjust accordingly. But that's not even, it's on the radar. It's option B, but it's not the probable case, right?
Yeah. And I'll just say that's one of the reasons why I follow you as my primary, just simply because I think you have that psychological feeling that a lot of us who are unexperienced traders, we don't have that, right? So it's so funny you put this chart up, right? And I keep on in the back of my head overlaying the, Wall Street cheat sheet. And I'm like, I don't think there's a coincidence why all those charts look the same. So it's the market psychology piece. And that's the piece that, like, for example, Cowan's missing, right? So it's just there's some trust and belief that you have to have right now. So I guess, like you were saying, hope. We're kind of in the hope phase. So
when it comes to Benjamin, I sincerely think, and from our conversation, he basically, like, if he sees this occur, if he sees this occur over the next, call it 30, 40, 60 days, he's going to be like, wait a second, he already mentally is aware something's different or off for his model. And he said he's preparing his community, but not only that, and this is where the most respects comes in, he'd be like, you know what, I want to prepare my community the right way. And we're going to, we're going to collaborate and make sure that they get on the right side here.
Yeah.
And if this happens, and then he's like, well, whatever, I don't care that my lengthening, I'm happy Bitcoin's trading so high. And not only that, I at the right time and early enough got on the right side of it. And now then I have the most respect for him that's possible. If this happens, and then price comes down and he's still holding on to it at that point. That would be like me if price is going here, still saying, no, it's still a 4-year cycle.
Yeah.
You know, if you're wrong, you know, there has to come a time and a place where you admit you're wrong and make sure that you want to be right. Otherwise, you know, you're just holding on to your milkshake.
Yep. Agreed.
Can I ask a quick question on the scaling of so just for the charts that we provide? So, you know, what are we agreeing on as far as? So I think we're agreeing on.
Oh, you're talking about the naming, Ian?
Sorry, no, the actual. So I think so at the moment I've got a chart that's on the all-time high, and I think we're saying that we're going to move the charts that I produce for you, Jordan, and put on Twitter for the community to these ones that we're gonna do them effectively to the mid-cycle shakeout. I think that we've agreed that. Yeah.
Listen, Ted, I'm going to let you answer, but I think so, with the one caveat, like if we find out together, you know, however we get there, that actually we're running up for the blow off top and going to peak in September, then I'm going to look back and I'm going to be like, you know what, this was actually this was an anomaly. It's probably like less than a, you know, whatever you want to give it, a 10% chance that that's the case. But I don't know for sure, which is why I've asked you guys before we got into this meeting and during the meeting, how certain are you that this is not an anomaly and this is the mid-cycle? I believe it is. I believe that you guys are dead on. And the chart that really makes it clear to me is when we looked at this together and you could see from the scale dip and you could see the symmetry. Hold on, bear with me here. And you see the symmetry that occurred from the past cycle over here, you know, going into when you see this, the peaks and then the trough over here, and then the peak and then the trough and then the peak and then the trough. It's lined up perfectly.
It even happens on 2016. It's just switched. I mean, if you can,
it's just lower, isn't it? It doesn't.
Yeah.
The price action is much lower, but it still exhibits those same smaller peaks.
So I can see this peak and this peak. Is that correct?
No, the one before.
This peak and this peak, correct? Or no?
Yeah, I think that's right.
And then this peak and this peak, and then this peak and this peak, they catch up over here. And then these, you can see very clearly. These,
look at that. They look almost the same right there. It's crazy.
Yeah. What we catch up.
So as they get closer, they effectively, the symmetry improves.
Which is why we should be right around here, right? Very soon. Yeah.
We should be, hopefully.
Yeah.
I think as you say, like the checks and balances is when you get into August, and if you know, and you don't, and you the price action isn't what you're expecting. You're expecting it not to dip and rip, and if it does, that's your signal. Yeah.
Okay. That we're actually lined up from the right. I understand.
So I'm happy with that. I was going to change the Ethereum BTC model as well to line up on the mid-cycle dip, because I think it's such a massive event.
Ted, do you track Ethereum?
Yeah, there's a button on it for it if you click it on in the settings.
Right. Well, what I guess what messes me up here personally is that when we do this, then because I don't know.
Yeah, it's just the prices are so horrendously large with the scaling. I mean, it's.
I really like Ian. Why I was asking is I really like Ian's work on Ethereum.
Yeah.
You know, and what he's saying, because there's a big difference between obviously alt season in 2016 and alt season in 2020. There's a difference between coming in to Bitcoin dominance into this mid-cycle shakeout, but also, and I think Ian is dead on when he talks about Ethereum in its second cycle being more mature, and therefore, even though it's outperforming, it's more closely tracking Bitcoin's movements and We just saw the mid-cycle dip on Ethereum. It occurred at the same time this time.
Yeah, well, look at it. You can see that V right there, right? It's,
But this is what you're looking at here?
yeah, that little, I mean, it's already recovered. It's already,
Go on to outperform. I don't
yeah,
The thing that's a bit off-putting with Ethereum is because effectively it does this, you know, very similar to the 2012 where it does a rip early and it goes, and
over here.
yeah, you get this rip, and effectively all that rip has already played out before the mid-cycle dip occurs.
Yes.
And then effectively from when Bitcoin has its mid-cycle dip, Ethereum also has a mid-cycle dip right on time. And
Here's
then
2016 in blue, Bitcoin having the dip, and here's Ethereum at the end of its dip at the same time.
Yep.
Mm-hmm.
So effectively they are correlated in 2016. The difference is that in 2016, Ethereum makes a much higher
pre-dip peak.
Pre-dip peak compared
Mirroring
to
this
time round.
Mirroring what Bitcoin's 2012 cycle.
Yeah.
As a young asset, right?
Yeah. Whereas this time round, we did see that effectively that separation and as we came into this mid-cycle shakeout.
Right.
Yeah. But it wasn't as pronounced, but it still, the dip still occurred. Yeah. So it got to like 0.8 on Ethereum BTC, the ratio. Whereas effectively on in the previous cycle, it got to 1.5. Yeah.
Yeah. So, and that's a whole nother thing to talk about. I saw you posted the Bitcoin dominance chart over here, right? If you're going back, this is now not Bitcoin versus Ethereum, right? This is Bitcoin versus everything removed from stable coins or anything centralized. But you could see Bitcoin actually making a lower, hold on, let me pull up Ethereum Bitcoin really quick. So what I'm trying to get at over here, this is the previous alt cycle. This is the peak, right?
Yep.
This is mid-cycle, right? This is the mid-cycle dip right here. No, sorry. This is the mid-cycle dip right here at the peak.
No, just open it up a little bit more. So the mid-cycle dip for 2016 is the 16th of July.
Sure. This is the mid-cycle dip right here.
So I think it's just,
I'm on a 3-day. That's the problem. Okay. So this is the peak of alt season, let's say, right? Is it possible that this is the peak of the first alt season over here? And is this making a lower high, right? And then what happens going out the next cycle? Do we see a lower high from here as well? A lot of people are expecting Ethereum at this particular time to take out this previous high. Is that going to happen this bull market here?
Well, the way I see it happening at the moment is that both of them at the mid-cycle shakeout in 2007. The mid-cycle shakeout, they both were at about 0.8 on Ethereum BTC. Yeah.
Here today, okay.
Yeah.
It's occurring right here.
Yeah. So before the shakeout occurred, it had effectively got to 0.8. Yeah.
Yes.
And then the shakeout occurs and it drops down to 0.6.
Right.
If you look at effectively the 2017, it's on its way down.
Right. Before the shakeout.
Before the shakeout, it's at about 0.8. Then the shakeout occurs and then it dips down.
Right.
Yeah. Then it goes sideways for about 2 or 3 months. Yeah.
Over here.
Yeah. And then effectively the 35-day blow off top occurs in Bitcoin, which drives the rest of this down. Yeah. So you get sideways price action on Ethereum Bitcoin because they're both tracking each other and they're both going up quite evenly. Yeah. And it's only once Bitcoin really starts moving in that last 35 days that effectively you see the Ethereum Bitcoin really dropped down to 0.2, at which point 1 week before the top, Ethereum starts moving and it gets all the way up to 1.0 to 0.1. Yeah.
Are we going to see this play out? This is where we are right now today.
Yeah.
Are we going to see something like this play out, you know, making a lower high like this? Or are we going to see continuing Ethereum continue to outperform Bitcoin, tracking it, thus causing us to come over here and actually break this pattern that occurred?
Exactly. So rather than you effectively have this sideways price action on Ethereum, Bitcoin, and then a drop, and then it comes back to and ultimately outperforms, you actually see it go sideways or increase during this mid-cycle point, and then effectively it blow off top either early. Yeah, that's what I'm. That's why I love your work on this. Again. Yeah, that's why
if we see that occur, though, the similar price action that occurred over here, if Ethereum does go on to make a lower high over here before the bear market, what are people going to say about their case for Ethereum? Because then looking on a greater scale, Bitcoin continues to eat Ethereum's dominance. No?
Well, I think what you'll see is effectively 3 months of sideways price action. So Ethereum will be going, if it does what it did last time, it will be going up, and people will be like, okay, cool, because all that sideways price action for 3 months, the ETH BTC ratio hardly changes. Yeah.
Over here,
it'll only be in, say, August that effectively suddenly Bitcoin will start moving, and it will be a case of Ethereum not moving fast enough, and then it will be more noticeable.
Or is this time different where Ethereum continues to outperform, more closely tracking Bitcoin?
Yeah,
and
exactly.
The question is from this mid-cycle dip right here, the peak, mid-cycle dip, the peak in September, October, is Ethereum, Bitcoin making a lower high like here? Or is this time different now that Ethereum is more mature? Does it continue outperforming Bitcoin and make a higher high?
That's if you do a kind of a worst case, just pencil whip of it, and you just say, well, if the target price of Ethereum is true, let's say 20,000,
right?
I mean, and 200,000 Bitcoin, that's 0.1. 400,000 Bitcoin would be 0.05, I think, right? So I'm like, you're looking like you're going to hit 0.1 at least, I'm thinking.
Exactly. And it's just how and I think that if it doesn't, if you don't get that volatility to the downside, yeah, during this part of the cycle, then I think the likelihood is much greater.
Okay, so if that occurs, if Ethereum Bitcoin makes a higher high over here, what do you think about going forward, even 4 years out? Does Ethereum continue to take away market share from Bitcoin? Does a flippening happen between Bitcoin and Ethereum?
Yeah, I think well, it's certainly going in the right direction. Yeah,
that's what everybody says is going to happen. I mean,
well, they said it back.
It's an application universe, right? It's not a monetary system, so they're just different things.
Yeah,
I mean, just depends on how you're looking at it.
I would have to lean towards that being correct if this happened. If the peak of the 4-year cycle, Ethereum Bitcoin makes a higher high this time instead of a lower high like last time, then I'm going to have to be like, 4 years from now, in that time, we very well could see a flip.
I mean, if you look at, I mean, I think you've said before that Ethereum's expected to peak out like 30 days, like within 6 weeks of the Bitcoin top. I mean, if you pick prices of 70% or 60% down from $200,000 or $300,000, I mean, you have a potential of getting to 0.4 on that chart. I think it could be much higher.
Wow, I mean, that would be
because you'd have 400,000. Let's say you went down to I don't know, 70 or 80 by that time, and you divide. Now you have a 20. You have a 20 over a 70. I mean, that
would be a higher high than last cycle, right?
Yes, I would think so.
That would be, in my opinion, a game changer.
I'm assuming 20 grand is the right answer. I mean,
I think if you're assuming 20 grand, then at that point, you're also, assuming 350, 400,000 on Bitcoin.
I mean, I did this sort of pencil whip back when Raul moved in.
Yep.
And it was really hard. I mean, I'll be honest with you, it's really hard for me to swap out of Bitcoin. I mean, I'm not saying Ethereum's as speculative as other coins, but I do agree with you that there are a lot of things that are going to happen in the Ethereum marketplace, right? To, vet itself out. I mean, there's an upgrade coming, right? There's ETH 2.0, there's going to be shard chains, there's going to be all sorts of cool stuff happening. Maybe this cycle it'll play out, but who knows? The next cycle it could be Cardano or something. I don't know. But there's definitely a lot of traction in the Ethereum marketplace right now.
Of course. Yeah. Ted, and Ian too, when I look at, if you just kind of in your mind hide the orange cycle, the 2016, and the blue over here, the 2016, right? And we're just focusing on the current cycle between Ethereum and Bitcoin. Now, this is the work that Ian has made very clear how closely that Ethereum and Bitcoin are tracking each other.
Yeah.
Right. You could see these peaks all occurring at the same time, and it's different than this last cycle. So as we move forward, I personally expect that Ethereum and Bitcoin are going to peak around the same exact time this cycle. I think it's going to play out much differently than last cycle. Right. We haven't. The only thing that would change that is if Ethereum goes into a long, prolonged consolidation, why Ethereum now gains dominance against it. Then I'd say, okay, well, it is maybe the possibility plays out. It mirrors more the peak of last time. But if things continue to play out as they are, as Ian's pointing out, it's a much more mature cycle. They're tracking each other with Ethereum outperforming. At that point, I'm going to think that actually that we're going to be watching Ethereum peak at the same time Bitcoin is peaking. That could hurt a lot of traders. You might find a lot of traders looking for that blow off top, which might not occur this time. So that's something to just everyone be aware of and watch out for.
So just regarding Ethereum, is there any capitalization or I guess maybe drawdown impact on Bitcoin when Ethereum is spiking? I mean, if I look at the 2013 cycle, for example, I see Ethereum spiking, right? And I see Bitcoin kind of trending sideways and down. And if I look at the same cycle here, it's kind of the same thing. It's like Bitcoin is kind of flat and Ethereum's kind of spiking. I mean, does Ethereum now have to stay flat for Bitcoin to recover? Is there some sort of interplay between those two that's happening? That's, are people hopping in between the assets now? I mean, my concern would be is if Ethereum starts taking off, is Bitcoin going to take off? I would hate to say that. I mean, usually Bitcoin's the genesis of all cash in the system. I wouldn't expect that to happen, but
I mean, under that premise, I just think we see Ethereum outperform Bitcoin. I don't think it takes away from the market cap of Bitcoin. When you look at, whatever institution you want to pick, they're buying Bitcoin, right?
Yes,
people ask, where's the money going to come from? Well, it's clear where it's coming from and where it's going. Right? And that might change in the future. But could you imagine someone putting $1 billion into Ethereum? I mean, it is unproven speculative technology. I don't think we're going to see that, right? Yet. Maybe.
Okay, I'm just curious.
Yes, I mean, I think that is, so just to summarize that for the first half of the cycle up to the shakeout, effectively previously Ethereum had a big spike and then started its way down, and then the dip occurred, the shakeout occurred on all assets.
The low of the dip is the low of the dip for each.
This time round, it did appreciate towards the end, just before the shakeout, but not as much.
Right.
On the old cycle, once the shakeouts occur, Ethereum goes up in price, and so does Bitcoin. For the first half of that half of the cycle. Does that make sense?
Yes.
Until effectively you get that second drop in Bitcoin, and then Bitcoin rips, and effectively Ethereum never catches up.
Is this point over here you're talking about, or are you talking about this part?
That part.
Yeah, you can see that little dip right there.
Oh, and then it goes sideways here.
Yep.
Yeah.
Okay.
Yeah. And that's where you get that on the Ethereum BTC. It's sideways and then it drops down.
Oh, so this particular point, we are expecting Ethereum to come up with Bitcoin,
Yes.
possibly, and then it's after that little bit of sideways when we start making that second wave. That's when.
So when we start that second wave before the blow, and then we move into that 35-day blow off top, what you'll see is that what you saw last time is Ethereum was going up in price, but it was not going up anywhere near as fast. Yeah. And thus effectively the ETH BTC ratio drops down to 0.2. Yeah. And then on the 7th of December, literally a week before the top, it starts moving and it goes from 0.2 to 1.1. So it goes from 0.02 to 0.1. It moves a huge amount.
Oh, he's talking
In the previous
right here, right where that little peak is you're talking about, right before 2018.
Yeah, so that's the
0.02.
dip. See that dip? That's like the 7th, 6th or 7th of December. There.
Right.
Yeah, there it is.
Yeah.
Yeah.
So you can see
that's the rip you're talking about, right?
Yeah, so we go sideways with Ethereum compared to Bitcoin. Yeah, they're both going up in price.
Where we are today is right here.
Yeah.
We're expecting, or not, I mean, this is what happened last time, was that as we came out of the bottom of the dip and we went into wave one, they basically went sideways with each other, both coming out of that dip.
Yeah.
Out of the bottom of that dip, you see Bitcoin really come strong. And Ethereum, although it rises, it's flat. Ethereum's pretty flat during this stage.
It's not going up anywhere near as fast.
Yeah.
And then 1 week before effectively Bitcoin's top, Ethereum then wakes up and then it actually rips your face off even more than Bitcoin does because it goes all the way to, 0.1.
Mm-hmm.
Yeah. And I think it finishes off on like the 1st of February. Yeah. So what I'm interested in is effectively how it behaves between now and say the next 2 months. If it effectively just goes up in line with a Bitcoin, then nothing new particularly is happening. Yeah. If it effectively goes up faster than Bitcoin, then my take is that you're not going to see that drop off to 0.02 of Ethereum.
Mm-hmm.
Yeah. And then it's how that blow off top phase with Bitcoin, how Ethereum works. Yeah. And like you say, Jordan, maybe it actually moves earlier in line with Bitcoin and has a blow off top at the same time. And you don't get that month after.
So Ian, by this, as we finish on Bitcoin coming up, wave 2,
yeah,
that should be when we know whether or not they're going to peak at the same time, or we'll see similar behavior last time. And it depends what Ethereum does during wave 2.
Sure, that's the key phase. That's the key phase. If you see Bitcoin moving up and effectively Ethereum going sideways in price and the ETH BTC going down.
In this period over here.
Yeah, that's all signal to say Ethereum is now doing what it did last time. It's dropping and it's going to come back very late. Yeah.
Yeah, great insight. If we start seeing actually them tracking each other during this wave, then I'm leaning towards them peaking around the same exact time. If we see here Ethereum actually go sideways, more or less, why Bitcoin actually makes a higher high, then we're going to see or be looking for the price action that occurred last peak to occur again.
Yeah. I'm not saying that Ethereum won't go up in price. I'm just saying that it will be delayed.
Yeah, well, from the bottom of the peak, Ethereum still went up in price, right?
Oh,
yeah, but
no, I mean like to the very top. It will be delayed for it to get to its, its 100x or whatever ridiculous amount it goes up to.
Wow, good stuff, great stuff.
So I'm gonna the charts that I do for you, Jordan, I'll and CTM, I'll center them on the Ethereum ones as well on the shakeout, because I really want to see that symmetry happen going forward. And I think that's going to be very clear for us to map out, this question. Yeah,
absolutely. And we discussed earlier, there's that one possible caveat that, hey, this is an anomaly. You know, we have to just be aware that it's a possibility. You know, that's not the base case or even close to it. I'm with you on that. I think Ted is also. Ted, I won't put words in your mouth, but
Yep.
The price action and the similarities that you really made clear to me, looking at the 2012 cycle and this current cycle, and especially how they all go in together, the 35 days or so prior, it looks clear that this is the dip. We should all be scaling from this point going forward to make sure that
we'll scale from that dip as well on price, not just on time. Yeah.
For me, yes. Ted?
Okay.
So it's a good question, because Ian, your chart that had the scale from, basically centered on the dip, but scaled by the prior all-time high price was pretty interesting, because that chart that you had on Discord, like, it was within a few dollars. I mean, it's crazy. Did you see that chart?
Okay, could you pull it up? Are you on the
Let me see if I can find it. Centered mid-cycle shakeout. Was this the one that was scaled?
Yeah, that's the one that I've scaled on the all-time high. So that's my original chart, and all I've done is just move the dates so that it's on the dip. And then I sent another one where it was, the price was scaled as well on the dips. But I
this one here, probably that one, right?
Yeah, I think I said centered and scaled at the top. Yeah,
yep, center and scaled.
Yeah.
It was just interesting, because there's not a lot of wiggle, like on mine, there's a lot of wiggle room, right?
Explain for me and for everyone else the difference between the two here.
So, go ahead, Ian. This is your chart. Why don't you explain?
No, you go for it, because I know that I'm terrible at explaining stuff.
Well, it's just from my perspective, there's two parameters, right? There's a centering parameter, which we're centering on dates. So this chart is centering on the shakeout date. And then you can make a decision whether you're going to scale the prices based on the prior all-time high, which is one model we're using, or by scaling on the dip low price here and scaling all the others. And what Ian's doing, this is not what I'm doing in my model, but what Ian is showing here is he's centering on the dip, but scaling by the all-time high price, prior all-time high price. And as a result, you have a very small margin. It's like, when I saw this chart, I was like, wow, that's pretty cool, because you're scaling from that price way back when, right? And it kind of struck me odd that it was so close in terms of range.
Now, could you pull up the chart for comparison?
Yeah. So like my chart would be
the other one of Ian's chart scale.
Oh yeah. So this is scaling all the same.
This is scaling off the low of the dip.
Off the low of the dip. And here you're just saying, everything's going to go to one's point. But it's just interesting, because
the other one is definitely more appropriate, no?
I think so, because he's basically called out just like you're saying, Jordan, way back at that all-time high break is a key point, because look how close these are. You're scaling by that number, and look how close they all arrived at. It's pretty interesting to me. It made me want to rethink the indicator, that maybe I should break out where you can scale and where you can like draw the dip, and you can just choose, instead of having one pull down that has all these things. But I'm not sure which one's right. I think we need to keep both in front of us, because I thought this was a cool chart.
I do too. But yes, you're right. We don't know for sure. So to consult both is for sure.
I mean, the thesis that has been working well has been starting from the all-time high. So I mean, this is this is really just kind of adjust. I think what Ian was referring to earlier is that anomaly, the 2013 anomaly, how it kind of shifts everything off a little bit. And now we're just saying, okay, well, we recognize now that the 2016 dip date and the 2020 dip date happened the same number of days, or like within a day or two of, I think it might be the same number of days now of like the cycle, right? The cycle days. Whereas 2013 had this anomalous shorter cycle for some reason we can't figure out. And we're just adjusting for that here. Yeah. I think that's what you were saying, Ian, earlier, essentially, right?
So my main concern, and I think I sent a table in the Discord chat, which showed, I think a couple of days ago. I think it was the price. No, sorry. I think it's further up. It was the hat. It was.
Hold on. Let's find it before you continue. So
Yeah,
we
sorry.
can keep up with you.
This one?
Yeah. So based on how we scale the price on the shakeout, we get these ranges in price for the top.
Okay.
Okay? So if we scale on the price at the halving, that would be the price at the top. Yeah. 828 and 256,000. Yeah. Now, if we effectively move across to the break of the all-time high, yeah, get a narrowing of the price range at the top, yeah. And then if we scale on the shakeout itself, we get an even more narrowing of the price at the top. Yeah.
Wow.
But what I'm trying to say is
Do you think that continues?
Not only does it reduce the top, it effectively increases the bottom, and that's the thing I don't like to. It sets us a higher bottom, as it were, and that's the thing.
You had a chart that showed that. Where's it at? Was it here or was it on the other one? You plotted that.
Those charts that you just scrolled past. I sent you 3 charts in the. So yeah, sorry. If you just go up a little bit more, there's 3 charts next to each other, just a little bit higher. Yeah, a little bit more. Sorry.
Oh yeah, here.
So I think that's these 3 are the. So you've got the shakeout, halving, and
now you had another chart where you had like ranges or something. I forget what. Do you remember what I was talking about? Oh, it's this one. Is that the same? Was that what you're trying to say?
Well,
or I think
so. So that doesn't actually show the top. So this was
okay.
This was me trying to. I like this one because this was a combination of 2 of. So this is what I was going to kind of say is if we take this approach of having more than one indicator model overlaid, we get this kind of wiggle room, as it were, on the chart. Yeah. So that was why I went with this, because it was, well, I've actually got the price scaled at the halving on this chart, and I've also got the price scaled at the all-time high. But what it doesn't show you is where you ultimately predict the top at, because I haven't put the chart.
Yeah.
Well, I mean, it's very interesting. You're saying as time goes by, we're able to narrow down the expected zone. It kind of goes off the premise of, using the halving to begin with to line everything up until the all-time high is made, the new all-time high, until the mid-cycle dip occurs, and us continuing to move forward until we even get to the rocket ship, right? The point right before the blow off top, because you should have another column at that point, right? As we get past the scale dip over here, and as we get to that, look, can we come up with a better term than rocket ship, where we're looking for the last dip before the blow off top, right? But just so you guys know what I mean, the rocket ship, right? Like once we get to that point, we should be able to narrow it down even further, or you should be able to narrow it down even further, the expected range. Yes or no?
Yeah, yes, because what you would do is you would scale the price off of that point.
Yeah,
all you're interested in is the price going forward.
Right.
Yeah. Does that? Yeah. So even though effectively, so I guess scaling on the shakeout price makes the most sense because you're only interested in the future.
Right.
To a certain extent. Yeah.
For me, yes, 100%.
Okay, so I see what you did here. So what you did here is you used the prior all-time high price, right? You moved it over so that the charts are all lined up. Yeah. And then you're using the non-scale dip before parabolic to kind of show the wiggle room, because that one doesn't scale. It just kind of gives you some nice boundaries to kind of say, here's some plus and minuses of where we could possibly end up. I think that's what you're showing here. It's
Yeah,
a pretty cool way of doing it.
Yeah. So on here, because I used your non-scaled dip because that's scaled against the halving.
Yes.
Yeah. It just was easier than me getting the halving model.
Yes.
And then
Dip before parabolic is scaled to the halving. That is correct. Yeah.
But what I would probably do, as far as, because I think this may be too difficult for me to do on my Excel. Yeah, I could try doing it. Is that we effectively do it, or we have a separate. So I think we stay on the scaled, and then what we do is you could have a separate model where you just use the all-time high in the short term, and you do this. So you have two indicators. One effectively is the scaled dip, and the other one is the all-time high, model aligned to the dip, and it gives you this, and then effectively, as we see price react, we can then decide if when it is appropriate to drop the all-time high price.
Yeah.
Because we're in because it's so violent, the down and up. It's
I see what you're going at. Yeah, we were talking about that earlier, Jordan, I think on a separate thread, that I thought maybe I should put this, because these has some parameters that are kind of lining things up, is that I should put this as a pull down. Just put these settings as a pull down. That way you would have like prior time break aligned to dip or something. But
well, I mean,
that's what I
think what's taking place here is a little bit of necessary nerdiness that you can't get to where you are without you yourself working out and doing.
Yep.
I get a little bit lost in following what's going on. I'm assuming that it's necessary to get where you need to be. Like you can't get to where you are and your insight and understanding without like going through the journey and getting. But once you like get there, you got to be like, hey guys, it's here, and you got to simplify it down a little bit.
Yeah, right.
Does that make any sense?
Yeah, I know what you're saying. Yeah. Yep.
I think we simplify it down by scaling on the dip for price and time, and we have a separate model, or myself and you, Ted, that effectively is this overlaid of two models, and we just have that in the background as let's keep an eye on how the price is reacting.
Yes. Yeah, I like that a lot.
And come back to Jordan and go, look, we're a bit like the stock to flow model where he says, oh look, I'm either in the bound or I'm outside of the bound into the slightly lighter color, and you can go, we're kind of off, but we're a standard deviation off or two.
Yeah. Absolutely.
Okay, I'm happy with that.
I'm happy with that too.
Awesome. You guys are the best.
Sorry about that, Jordan. Put you through that.
What else? Is there anything else?
No, I think for me, I know what I need to do, so I'll get on and do some charts and make some people on Twitter happy. I hope, because they're probably wondering where I've gone.
No, you do the right thing at the right time until there's clarity. Look, this is the moment when not just today, today's the 25th, right? Going back a week ago, I'm like, hey, listen, now pause a second, wait for clarity. You can't be putting out this type of position until it's clear, right? You're doing the right thing. And then, and even going forward, these next few weeks, we want to take that cautious approach. Even as Ted said, okay, maybe it's, 5% chance that we enter some type of long-term, accumulation phase. We're aware of the possibility. It's not our base case. It's not even close to being it. But if it happens, we're already prepared for it. We'll continue working it out. But it was way better than I expected. We guys covered a lot of ground, and I'm walking away personally, just seeing
with a headache. Sorry.
What'd you say?
With a headache.
No, not even a little. I absolutely love it. And I think one of the highlights too was just seeing a lot of people have been saying, Well, now currently this current market is resembling a lot more the 2012 cycle to me. I couldn't see it. I couldn't get over the fact that, well, I'm seeing them the average of the two on the upside, on the downside, and now sideways, but actually mirroring much more 2016 until you showed me the similarities of going into this dip between the 2012, except this one is more smooth, but it has it's really awesome stuff. Really awesome stuff. So I thank you both so much for spending time with me.
It's always good to chat. Sorry if we I chat too much, I know. So
not even a little, not even, if anything I do, I should just get out of your guys' way. And but you know, I loved it. So thank you.
Yeah, so good luck with the baby. I'm sure it must be.
Well, my wife has seen the doctor. I should call her and see what's going on. I can't believe she hasn't called me. That must be good news. I'll assume that she's coming home, but you know, we'll see. She's with her parents at least. That's good.
Awesome.
Find out right now. Yeah.
Right. I will let you go. You've got much more important things.
Oh, there we go. Hey, Michelle.
How are you doing?
Wow. How is your timing so perfect? How's that even?
I just finished dinner.
Oh, wow.
How's the wife? How is she doing?
And there we go. What a beautiful, what an important session. The greatest shout out right there to Ian and Ted and to Michelle. Thank you everyone for sharing in this. The replay is available on the Conquering the Markets playlist. If it's not available immediately, it will be within the hour, however long it takes for YouTube to process it. Everyone, thank you, J-Boy. Everyone, have a beautiful day. We'll talk to you soon.